You are listening to Keystone's Stock Talk podcast, episode 173. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We are back this week, starting with a brief discussion on the strength in consumer spending as reports of recessionary fears smack us in the face. Our stock battle is back. In the crosshairs this week is Absolute Software Corporation, ABST, on the TSX, a provider of SaaS-based endpoint security and data risk management solutions. Brennan charges in with the bull case, while Brett tries to maul him with the bear case. It's Alberta versus Saskatchewan in a battle for provincial supremacy. Aaron will act as judge, jury, and executioner for this epic battle. Our Your Stock Our Take segment will take a look at automation development and manufacturing company ATS Automation Tooling Systems, ATA, on the TSX, which plans, designs, builds, commissions, and services automated manufacturing and assembly systems, including automated products and test solutions. A listener asks us our thoughts on the company, which has consistently posted strong growth over a 10-year time period. Aaron will handle our star and dog of the week. The dog this week is Maple Leaf Foods, Inc., symbol MFI on the TSX, which produces packaged food products globally, including prepared meats, and Brennan's favorite wiener, Schneider's, as well as ready to cook and ready to serve meals, snacks, kits, fresh pork and poultry, and plant protein products. The stock was down 17% last week after the company released second quarter results. Our surprising star of the week is Coinbase Global Inc., symbol COIN, on the NASDAQ, which offers crypto/trading exchange platform where individuals can buy and sell cryptocurrencies. The stock IPO'd in May of 2021 at a price of around $340 per share, recently dropped to the $50 range, but posted significant gains this last week after it announced a deal with BlackRock. Is it a sign of a recovery or just a dead cat bounce? Aaron will let you know. So without further ado, let me welcome my co-hosts, Aaron, Brennan, and Brett. How are you guys doing?
Doing
Excellent.
well.
How are you, Ryan?
Good.
Great.
Getting ready to
Approaching the end of the summer, about to enter into the fall season.
Getting ready to go on vacation. Yeah, so I've already checked out, so I don't even know if I'll listen to this. Actually, you guys are doing a battle. I don't even have to really listen. Aaron's going to be the judge, right? And you're going to... So I might leave for a little bit.
Yeah. So this is Brett's first battle ever. Brennan is coming in as the old lion, a little more experience. Well, a lot more experienced
in losing,
actually.
It's true.
How many battles would you say you have under your belt? Right. Yeah, almost exclusively, but
I got quite a few. I don't know,
Yeah.
but I had to make sure that I wore
15 battles.
Look at him. Is that a new
my
suit,
three-piece
Brennan?
suit.
Oh, wait, is that red? Is that suit? What color is that suit?
It is. It's a burgundy. Yeah, it's like a red burgundy.
Okay, I didn't notice that. It's kind of hard to see with the screen. I have to say that, what dominated the ratings last week was Brennan's shirt.
He brings it with the burgundy.
It went on fire. People were loving it or hating it, but everybody.
Somebody shouted out,
it, right? So it pretty much dominated everything else,
right? And about the massive size of my mic, right? So we brought that down. Look, we're listening to the listeners. The massive size of my what, Brennan? Pardon, my mic, right?
Yeah.
Come on, it's a family show, Brennan.
Yep, your mic.
But I didn't notice that you're wearing a burgundy suit.
I think it looks good.
Taking it to the next level again.
Although he's got those.
Yeah.
Thank you.
It's interesting because for me, it's always the question in the post-pandemic work world with, dress code and like what's appropriate to wear in certain situations like podcasting or in the office or working from home. And Brennan basically made the statement that anything goes.
Yeah.
Like after that shirt last week, Brennan's basically saying, you don't
one,
even need to wear a
One time
shirt
I'm going to randomly say,
it's just
focus the
goes.
camera on down to like what we're wearing below, because, you know, like Brennan may have the suit up top, but he's probably sitting there in shorts or underwear or something like that. Oh, fully dressed. That's impressive.
I'm fully dressed. I'm fully dressed. No, I promise.
I think we already know
it's true.
What Ryan's suit looks like.
No, Brennan, I think it looks sharp. You look good. You look good. Mm-hmm. So let's get into it. Are we in a recession? This is a question.
You know, if I thought you looked horrible, I would just say nothing.
Are we in a recession?
Ryan,
it's a question that we keep getting like on a daily basis. In our weekly chat sessions, for sure, we'll probably answer that question tonight. Well, we got some data, July data from MasterCard that that we can comment on here today, and there's some of it right in front of you. But I'll go through it for the people on the podcast who aren't viewing this. Total retail sales ex auto and gas for July accelerated 9%. E-commerce sales growth also reaccelerated, up 11.7% in July versus up just 1.1% in June. So, real strong growth numbers there. It really says to me that the consumer looks to be continuing to spend. But one thing I'd ask about this, I don't know if you guys know, are these numbers inflation adjusted, or does everything just really cost more, making these numbers look more robust than they should? I don't know if anybody knows there. Nobody's got anything. I don't think so. So is everything just costing more? We're actually spending less, but we're getting less for our money, but the absolute aggregate dollar number, absolute dollar number looks higher. I'm not sure. It could be there. I would also caution that there's a lagging effect. Again, we talked about this last week.
Well, are you asking about inflation,
exactly.
whether or not these numbers factor in inflation? Or if they're real growth? I would say certainly. I haven't looked. I'd say certainly I would expect that they factor in inflation.
Yeah, I'm not sure if they do.
These would be nominal dollars.
It's just MasterCard spending numbers. Is it?
You don't think that they did?
So I don't think. Yeah. Okay.
That's what I mean. I mean that they would be nominal, not real.
Yes, I agree. I agree completely.
Right. I think that we're agreeing. Actually,
I would
like they would just be the nominal.
Yeah, we're agreeing.
Yeah.
Now, I would
They're not
also
adjusted
caution
for inflation.
that the lagging effect, like we said last week, of rate hikes and surging inflation can have on spending patterns. You kind of can cruise along with that same spending pattern that you've had for a couple years until maybe the credit card bill hits or starts to mount and it becomes real for you. So we may see something like that in terms of what's going into effect right now. But are there any thoughts out there of whether, if we talk about what a recession is, just generally speaking, it's a period of economic decline signaled by an increase in unemployment, a drop in the stock market, a dip in the housing market. An official recession really is not declared until the total value of goods and domestic services, for example, in the US, the GDP has declined for its 2 or more quarters. That's about 6 months. So that would be your official definition. You can be in one and it hasn't been defined yet. But as far as the unemployment side, we're not really seeing that. We talked about non-farm payroll. It rose last month and the unemployment rate was at 3.5%. So on the employment front, things look good. You certainly have the side of higher interest rates and higher inflation. Although, are they high? Interest rates are rising. They're still not historically high. Inflation is a real issue for sure.
Yeah, so I'm going to say that we're not in a recession. And so if you look at the technical definition, in the United States, GDP has declined for 2 consecutive quarters. So that would, I believe, fit that description. So those are sequentially, not year-over-year declines. Those are sequential declines. But as you said, Ryan, the employment, people, there's tons of work, right? Like people are making money. Inflation is high, but wage growth is also positive. You have record low unemployment. You had a surprisingly strong jobs number last month in the United States. Now in Canada, we actually, GDP wise, we actually haven't hit we haven't seen those 2 consecutive quarters of decline. So, technically you couldn't even argue that we are. Our jobs numbers were weaker. We lost some jobs last month, but the unemployment rate is still basically at a historic low. So I think that, it's almost like we're in something different where everybody's just kind of like sitting and waiting. It's like, you're looking at some nice weather. You're on the beach. It's sunny. Everything's great, but the bad weather's coming in. It's just a matter of like when and how bad it's going to be. So I don't think that we're there yet, but I do think it's almost like it's something different, right? Because it's not. Yeah. It's also just not your normal expanding economy either.
Even on the inflation side, Aaron, like it's different because like the supply chain issues that we saw, if those are corrected or alleviated, we could see pressure easing. And it's not Certainly. Just from rising rates. Like that could, there's an argument to be made there as well. So it is really extraordinary or unique times that we're into now.
Can I share my screen for a sec here? I'm just going to pop up a couple of charts. So these are just what commodity prices have been doing recently. Let's make sure I'm doing this properly. You guys see?
Yeah.
We see.
Okay, so this, for example, this is just copper. So we'll look at like some commodity prices, right? So big decline in copper from the peak, up around 480, down about 360, and same story for most commodities right now. So what do we have here? This is iron ore, way down from its over the last year and also from this peak in March. Look at lumber. Lumber is down significantly from its highs, right? Even something like oil, if you go to crude oil, it's not down significantly, I would say, but it got up around 120 earlier in the year. Now we're down about 90, and gasoline as well. So this is US. So if you're driving in Vancouver, don't say that's not what I pay for gas. Peaking at about $4 in June and now down to about $2.88 per gallon. So, there's been, certainly on the commodity price side, there's been a big, there's been a lot of downward pressure on prices. Let me stop sharing here.
For sure.
And you think that that's going to start to trickle in. The labor market, I don't know, that's a completely different beast. It hasn't shown signs of softening yet.
Yeah, like just to look at the non-farm payroll, the NFP, like the U.S. economy ended up adding 530,000 jobs in July, and the consensus estimate was only 250,000. So, it's looking very robust, at least, how much jobs they're adding.
But
sorry, Ryan.
I want to see some weakness in the job market, right?
Sure.
Like that's what I want, because until we start to see that, or until we start to see inflation come under control, the central banks are going to continue to increase interest rates. And that's really what's dragging on investor sentiment right now. But I do think, if I'm looking, I'm never going to try and predict what's going to happen with inflation, what's going to happen with interest rates. But I certainly see, if you're looking at this from like a monetary expansion perspective, we should start to see inflation ease around the end of the year. And as well, that's when all of these like lower commodity prices, assuming they remain lower, should also start to show up in the inflation number. Because right now we're still comparing ourselves year over year with relatively lower figures. But once we start comparing ourselves with the first quarter of 2022, I would definitely expect to start to see some easing.
Yeah.
Yeah. Well, so much of it's just energy too. Like you can just look at this guy. Here's the U.S. for the last CPI numbers. How much of that's energy right there? Mm-hmm. That big bar there. Like,
and so energy right now, I think, is at the lowest price, crude oil anyway, since the war in Ukraine started right now.
Yeah. That's.
Yes. Yeah. And there's a couple other, but as an aside, do you guys know why they call it non-farm
Because it's
payroll?
all the jobs except for farming, right? That it goes.
Yes. Yeah. And there's a couple other, but
farming
why?
Seasonal, I'm going to go with.
Why are they excluding the farmers? Why are we getting rid of the farmers? What do we have against farmers, or what did the U.S.? It actually goes back. Here's a rare fact. I don't know why I know this. It goes back to I think it was the U.S. Department of Agriculture, like in the 1800s. Maybe I'll do a video on this for one other. but I think this is when like half of America farmed, right? So I believe they did it for a couple of reasons. There is cyclicality or seasonality. They had farm workers working like half the year or around harvest season, but also like it would have dominated the statistics completely, right? So they wanted to look at the rest of the economy as the economy was evolving. But I believe that's the reason. Maybe I'll look at it. But I mean, now I think it's like 0.5% of.
So you may as well just include it and just say payroll, right? Right. Because it's not going to move the needle that much anyways.
So I think why don't we start a campaign to get the farmers?
I mean, construction is.
Like, why are we discriminating? Why are we calling this
is seasonal in a lot of
good point
too? So.
I love
me
farmers.
too.
Bring
Saskatchewan.
them back, right?
There we go.
Alberta.
Exactly.
Speaking of Alberta and Saskatchewan, I hear we have a battle.
Let's get to a debate,
Ruin.
right? Or wait, no, we still wanted to look at. There was a little interesting bit of news this week. Amazon bought iRobot. It's kind of iRobot famous for their Roombas. Do you have one?
My parents have one.
I bought two. I bought two. I never use it though.
Yeah.
Never.
You end up just vacuuming.
It doesn't even look good. It's like in a corner somewhere. Actually, we may have just gotten rid of it by now. I don't know. We used it for the first while. It worked fine. This was probably like 8 years ago or something. So maybe the tech has improved since then. But I just found like you kind of had to do like a lot of prep in the room before you let it go, like just making sure that everything was, out of its way. And it's really almost as easy. And you also have to do the corners. It's not good at the corners. So it's almost as easy for me anyways, just to vacuum the room. I mean, if I'm going to go through all of that, then just vacuum the room yourself.
Yeah.
Once again,
what it's really good for though is maintenance, right? Like you just let it go and it's not going to do the main job, like the heavy cleaning, but it's something you could throw it out there like once a week or twice a week or something. And it will, it'll kind of maintain things decently.
Yeah, my mom always complains because my dad thinks that it does the heavy cleaning. So my dad thinks that that's vacuuming around the house.
It's all the robot. It's all the Roomba.
Sorry, Dad, throwing you under the bus.
Yeah, you just, your poor mom, right?
Yeah.
That's what I can say.
Yeah. As
you say, she's a saint, right?
Colleen is a saint. Yep.
Colleen's got her name in there. We're good.
Yep.
No, but Amazon has been in the robotics space. They acquired a company named Kiva Systems, but that was more robotics, solely focused on warehouse fulfillment. But they do have one robot that I don't know if you guys have seen it. That it's kind of like your mobile Alexa, and it's called Astro. It's like a cheery bot that'll follow you around. It even has like a tray to fetch a few things. Yeah. I think like with Alexa, the goal is to follow you around and kind of have it, do what you're told, do what it's told, clean, fetch things. Kind of sounds like a pitch for Brennan's dating app. That's what I am.
Yeah.
Yeah, sure.
Well, I think that's the idea, like with the robotics, the home robotics is the million or the multi-billion-dollar, trillion-dollar technology is when you can actually, have your own maid, essentially a robotic maid in your house doing all the work. I think that, it's probably a little ways from that. We are probably a little ways
Can't
from
be
that.
soon enough, right? Can't be soon enough.
Be a little weird though.
It's true.
Yeah. Be a little weird.
Be weird. Yeah. It would be totally. So let's get to our battle, because I'm excited to see how this turns out. In the crosshairs this week, like we said, is Absolute Software Corporation made a really significant acquisition over the past year. Brennan has the bull case. Do you want to go first, or?
I will go
Brett
first, yes. Unless you want to go first, Brett.
No, you go right ahead.
We flip for this one.
I will go first.
I'm going to set up my timer.
Aaron, are you ready? Are you ready? Do you got a stopwatch?
Yeah, I have one here.
Yeah, timer, whatever we use these days.
Yeah, this time I didn't do a slideshow presentation because I really had to take it.
But you're saying you don't even take Brett seriously enough.
You don't have any quotes
to do.
Yeah. Oh, I take him seriously. I'm just taking it easy on him.
Yeah. We'll see if that was. We'll see if that's wise. Is he taking it easy on you? No, probably not.
Probably.
Well,
not.
I'm going to tell you right now. I'm going to say up front right now, Absolute Software is a company that I'm familiar with. I've looked at it multiple times in the past. So yeah, I'm interested to hear what you guys.
So you know beforehand that I'm going to win.
Brennan.
Yeah. And I think it may be a changed company.
There's a reason why
What's that?
It may be a changed company since the last time you saw it, Aaron.
Maybe not the last time, but it has gone through a lot of changes.
Yeah.
So I'm going to Brennan. Are you ready? Okay, let me
I am
actually
ready.
change the alarm here because that would be really funny. There we go.
Ah!
All right.
Bull versus bear. Stock battle.
This makes for great radio.
Twinkle Bell ending the stock battle would be less climactic. Okay. Are you ready, Brennan?
Yeah. I'm ready.
Go.
Number 1, Absolute has sticky revenue with annual recurring revenue of $202 million. Plus, it operates in one of the fastest growing industries, with Fortune Business Insights projecting a compound annual growth rate of 13% to 2029. The company has a solid runway of growth following the NetMotion acquisition and is looking to expand into Europe, the Middle East, and Africa. The company grew organically at 18% in the last quarter and has supplemented growth with acquisitions, trading with an enterprise value to EBITDA multiple of 17 times. It's a quality name that can offer value over the next 3 to 5 years. Though the company has levered up, it has a net debt to adjusted EBITDA multiple of 4.3 times and an interest coverage ratio of 1.8 times, which should be sustainable. Plus, the dividend could always be reduced, adding a margin of safety for the debt. Number 4, Absolute provides investors higher risk investors the option for some exposure to a Canadian technology cybersecurity stock that pays a dividend yield of 2.5%.
Okay.
I made it through that.
I don't know why this didn't ring louder, but
little stumbling though. Little stumbling.
That's all right. Thank you. So you ended right on time. You ended right on time.
Good.
Okay.
Yeah, with some stumbling. So
excellent. Yep. Okay. Brett, are you ready? I'm gonna have to get a better ringer next time. Okay.
I am ready.
Brett, go.
Absolute is an over-leveraged company hiding in its risk beyond reasonable return. The company has a massive debt-to-equity ratio of 35 times because it has been unable to produce income or running a deficit over the life of the company, and has now taken on massive debt of $278 million. Sure, it might have cash flow, but that's only because it receives cash up front for its services. Once new customers dry up, cash flow will drop dramatically, ultimately leading to problem servicing is significant interest payments. 2, the valuation is way too high. The company trades at a sky-high EV to adjusted EBITDA of 70 times, a price to adjusted earnings of 22 times. The earnings and adjusted EBITDA would need to rise dramatically to justify these valuations. You may say the acquisition of NetMotion will justify these valuations, but the problem is they overpaid. They paid $342 million. 68% of that was $234 million of goodwill, which is just accounting speak for overpaying. The industry of software security is highly competitive and constantly evolving. The company prides itself on being the first zero trust network access, but being first just makes an easier path for larger players to enter and push out over-leveraged companies.
Time.
That was a lot.
All right. In there.
That was a lot.
That was a lot. Yeah. Wow.
Thank
okay.
You.
Absolute Software. So as I said, a company that I have looked at myself several times in the past. So you both brought up some valid points. Sometimes you were both arguing, like when it came to the balance sheet, Brennan was saying that the balance sheet was okay. Brett was saying that the balance sheet was over leveraged, right? 18% organic growth on revenue. That's great, Brennan. You never mentioned anything about earnings growth or cash flow growth though. So, I did make note of that. But then again, neither did you, Brett, right? So is cash flow down? Is it up? Is it flat? Like, I don't know. A little history on this company. So Absolute Software, it used to be what we call a cash-rich business. So it had a huge net cash balance. This is one of the reasons why we were really interested in it, because we like these types of companies because they have the flexibility to go out and make these big acquisitions without taking on a lot of debt. So Absolute Software, they went out, they made the big acquisition, but they also took on a lot of debt, and their balance sheet afterwards just completely it completely changed, right? So now instead of being a net cash business, they're a high leverage business. I'm just going to come out right and say, like, that's one of the reasons why I don't like the company. It's a high leverage business, 4.3 times net debt to EBITDA. That's high, especially for a technology stock. Typically in this industry, we would want to see below 2, sometimes even net cash. 1.8 interest coverage. That's really low. That's low. I would consider that low even for a real estate investment trust. 35 times debt to equity. Now, that's extremely high. The only thing is that like equity is an accounting item. It doesn't necessarily reflect the true value of the assets, but that's extremely high. I don't mind the valuation of 22 times adjusted EPS if that organic growth is transferring into really strong earnings growth and cash flow growth on a per share basis. But last time I looked, it's not, and neither of you have really told me anything that's different. So I have to just assume that the company has kind of continued to underperform on that basis. Right away is when I'm looking at this company, the balance sheet just puts me off. So I'm going to give this one to Brett for his first win, his first victory.
What?
Yeah. Let's go. Let's hear it.
What?
Congratulations.
Finish him.
But you want to know what? So I do have to say that I didn't realize we were doing a battle until this morning. And I took a look at the company because Brennan had mentioned that he was taking the 4 position. And I saw what company he was taking the 4 position on. And I'm like, well, he must be up against Ryan. And Ryan has just duped him into taking like basically an unwinnable,
We flipped the coin.
An unwinnable fight here.
Brett,
Okay, well that's Well, I know it was Brett. Yeah,
I flipped the coin too. It wasn't me. I wasn't really
well, you can't accuse Brennan. You can definitely not accuse Brennan of doing something underhanded to get the better position here, because I knew he had an extreme uphill battle. So it's a good one for Brett. Great victory. I will admit, though, you're kind of throwing a softball there. So,
may have been lost
still,
on the flip of the coin.
Props to you. Yeah.
Or one.
Yeah. This one, I would say it was pretty much lost in the flip of the coin with that balance sheet. And without either of you really getting into the earnings growth, I just don't see how Brennan could have.
Yeah, I just think the balance sheet is, me and Brett were talking before, and I think we both knew.
I do note on the company, cash flow from operating activities was up to 17 million from 7.3 in the last period. So some of those multiples that we're quoting there may come down if the company can continue to execute as it did in the last quarter. There's not one thing I can say. There's just not a lot of great tech in Canada. We'd love to have a few more great tech stories, and we're continuing to look for them. But, the breadth of technology companies is not there. And that's why one of the reasons why we look to the U.S. often for tech exposure in our portfolios. You just don't find it in Canada. And, when we review many companies, if it is a good company, it's either very, very expensive, or they're just, there's whale crap companies that are just at the bottom. And we're not saying Absolute's that. It's certainly probably somewhere in the middle.
No, it's a legitimate company. It just hasn't performed. I mean, I've been looking at it for years. I think that it's underperformed. If memory serves me, targets post acquisition. Maybe it's going to turn it around. I really hope it does, because we need more great technology stories in the Canadian markets.
Yeah. And I think it'll be interesting watching it, pay down its debt moving forward. Let's see what it can do, But yeah, I agree with the conclusion. I definitely didn't deserve to win that. No.
Far from.
Yeah.
You deserve better, Brennan.
Yeah, thanks.
It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
I'm going to get to our Your Stock, Our Take of the week. It's on ATS Automation Tooling Systems, Inc. ATA on the TSX trades around $42. It's just under $4 billion in market cap. What does the company do? Well, they were founded in 1978. Plan, design, build, commission, and service automated manufacturing and assembly systems, including automation products and test solutions. They operate in 5 segments, the largest of that being life sciences. Then comes food and beverage, transportation, consumer, and energy. Now let's look at financially how the business has performed over the past 10 years. And all but one of the last, 10 years, it has a solid history of operating income growth, and it has posted revenue growth in all but one of those 10 years. So solid track record there. Fiscal last year, essentially 2022, it grew its revenues 53% to $2.18 billion. The company's operating margins were 13.4%, which is within management's current expected range of 13 to 15. 15 would be a long-term target. Their GAAP net income grew by 68%, in the fourth quarter. Order bookings grew by 38%, and the company does have a net debt position of $966 million, but the debt to equity ratio is slightly higher, but it's just 1.12 times. The company has an interest coverage ratio of 5.8 times. So, there's some look at its balance sheet as a look at the last quarter and year end as well. As far as on a valuation basis, the company has a price to earnings ratio right now trailing of 32.5. Enterprise to EBITDA is around 14, and on a GAAP basis, it's that's on a GAAP basis, 14.26 times on an adjusted basis. Price to free cash flow is around 24.3 right now. So we see the company positioning itself to be a significant player in the automation industry. The company has been aggressively pursuing acquisitions, which have increased financial leverage due to the debt taken on to purchase these acquisitions, but it remains manageable and could help push the overall margins up to management's long-term goal of around 15%. While consolidated growth was very strong in fiscal 2022, organic growth, while decent, was in the range of 10% in the fourth quarter and may not be enough to justify a PE of over 32. So analysts are expecting continued growth in 2023. If the company's PE can move back closer to, say, the 2025 range, it may look more attractive. They have been run well over the long term and grown revenues again over the last 10 years quite well, but we would find it more compelling on a pullback maybe in the 20 to 30% range. Right now, we just sit on the sidelines and monitor this company, but it does have a good track record of growth for sure. You can certainly do worse in the market, is what it's saying.
Yeah, if you look at the historic track record of this company, the historic growth, I mean, I would say it would be a no-brainer of a buy. But, really we need to look for it. And is that growth sustainable? So, 50% growth in revenue. Well, if you look at analyst estimates, they're expecting, I believe, about like 5 to 8% growth in earnings per share this year and next on average. So growth is expected to slow. Acquisition, and that's the thing. Are they going to be able to continue making acquisitions? Some companies are in an industry where they do almost have an unlimited source of acquisitions to make, and they can continue to grow like that. Others, it's going to be very spotty. So you really have to look more at the organic growth. But the fundamentals look great. Just a matter of where does the growth go from here?
For sure. Any further comments on that company, or should we move to Aaron's star and dog?
Let's move on.
Let's get to those, right? Yeah. Aaron, you want to dog
okay,
it first,
let's,
or you want to start?
I'm gonna go with I like to leave the
leave
more positive breakdown for last.
You're so
yeah.
Brilliant.
Exactly.
So your star of the week is?
Okay. We'll get to that. We'll get to that, my friends. Okay.
I was screwed.
We're gonna go to the dog first.
Sorry.
Yeah.
Jack.
From our Stars and Dogs segment, it's time for this week's Dog.
Dog of the week. We're going to start with Maple Leaf Foods here. They are a food packaging and processing company. They offer prepared meats, ready to cook, ready to serve meals. Brands include Maple Leaf, Schneider's, Greenfield, along with many others. So this is a $2.8 billion market cap company. Trades for about $22. They're based in Mississauga, but they own 29 processing facilities across Canada. Just last week on Wednesday, the stock released its Q2 results. Price was down 17% after the release of the results. So were these results so bad? Well, let's take a look. Revenue up 3.1%. Operating margin down 60% from 5% last year to 2% this year. So right away, as we see a major decline in operating margins, but also just a really low margin, almost break even at 2%. And then adjusted earnings per share, nil for the quarter compared to 29 cents last year. So yeah, I would say at face value, these results were really horrendous. Looking at some additional financial stats, 3-year growth rate of 8.7% per year. Now that growth rate has declined recently. Net debt to EBITDA multiple of about 4 times, a little over 4 times. I would say that that's slightly leveraged balance sheet. Now, this is a manufacturing company. It's a very capital intensive industry. We would expect them to have debt, but still 4 times net debt to EBITDA That's on the high side for me. And then price to earnings 44 times. So I would consider this expensive, particularly when looking at the state of the company's financial performance. Now, what I would normally do looking at these numbers is I would just disregard this company completely. However, if you look at analyst estimates, analysts are actually expecting a lot of growth, a little bit of growth this year, but $1.11 in earnings from 103 last year. But earnings doubling in 2023 based on analyst estimates. Now, I'm going to tell you, I would not trust these estimates as far as I can throw them. Do not depend on analyst estimates. But it's at least worth looking into. Why do analysts believe there's going to be such a big increase in earnings per share next year? Well, I did a little bit of looking around, and the company is making some investments into its operations. One of the things that it's doing is it's building a new plant in London, Ontario. And once this plant is fully operational, which would actually be the end of 2023, it's expected to generate about 100 million annually in adjusted EBITDA. So that's about a quarter's worth of EBITDA. So there is some growth potentially on the horizon for this company. But you'd really have to dig in deeply to find out if analysts' projections are just basically ridiculous or if there's maybe something there. So what's the conclusion on Maple Leaf Foods, dog of the week? The fundamentals have really deteriorated this year, and the valuation looks expensive based on trailing earnings. We could look into the analyst estimates and see why they're expecting so much growth in 2023, but right now we would not purchase shares of the company in its current state until we had more information.
From our Stars and Dogs segment, it's time for this week's Star.
And next, we will go to our Star of the Week. Very topical. Coinbase Global Inc. Coin is the symbol, trades on the NASDAQ exchange. So they are a cryptocurrency financial infrastructure company. Essentially, what they do is they provide a crypto trading or exchange platform where individuals can buy and sell cryptocurrencies. The company just IPO'd in 2021 in May at a price of $340. Right now, it's about a $25 billion market cap company. So this company is up over 50% over the last 5 days. Now, don't get too excited here. The stock is also down 73% over the last 12 months. So definitely a lot of information to unpack to figure out what's going on. But what is the reason why this company would have such a big move over the past 5 days? Well, certainly it's not the company's financial performance. Now, the Q2 results are actually due out tomorrow on August 9th. So we'll have to look a couple months back at the Q1 results, but still, negative 27% revenue growth year over year in the quarter. Operating cash flow was negative $830 million compared to $3.4 billion. Adjusted EPS was almost negative $2 compared to positive $3.80. Now, there's a lot of noise in these figures, just the way that they report their financials, almost like a bank. So when you look at that operating cash flow in Q1 of 2021, there's a lot of that which is actually capital money received from their users in the form of deposits. So that's not really their money. But what is then? It's certainly not the financial results. So what is it that has driven the stock 50% in the last 5 days? Well, the company on August 4th announced a partnership with BlackRock, where essentially Coinbase is going to offer their cryptocurrency platform to institutional investors at BlackRock. And they think that there is major potential in this. Now, beyond that, of course, there's a few other things that happened in response. Certainly meme traders started to pile into the stock, and also there's been a short squeeze with the share price moving up. So does this mean that the company is a buy at the current price? Well, I would say no. For us, the fundamentals have deteriorated. Over $800 million cash burn in the quarter. So that's a lot of money that they're burning through. They cannot keep that up. It is not sustainable. They have $3.3 billion in debt and no current operating cash flow. If you are to look at the company's balance sheet, you're going to see a big cash balance of about $6.7 billion. But don't believe that, because if you look onto the liabilities segment of the balance sheet, you're going to see that there are deposits owed to the company's users of about $12 to $12.5 billion. So this is not cash flow. This is not a cash balance that they're able to use to pay off their debt. Now, the big potential here is in the deal with BlackRock. And I think that likely there is probably some big potential there. But ultimately, we need to see concrete results. And it's still speculation until we see that. The results are due out tomorrow, August 9th. We can take another look. But right now, certainly, it looks highly speculative, high risk. We're not buyers. And that's all I have to say about that.
Perfect.
Excellent. Thanks for the summary. I mean, as I understand too, with Coinbase, like relative to other traditional exchanges, they charge a relatively high fee. And like I would think that over time, like that, as the competitors come in, would that not be eroded? The margin be eroded over time? So that would be something to look at.
Yeah, definitely. And that's what I mean. That's about understanding the business, right? It's, you know, you can look at the financials, you can look at what they've done historically. If you look at the trailing financials on this company, I mean, they had last year, you know, very strong cash flow, at least, you know, when you look at the headline numbers. But you really would need to look at what's going forward, and understanding the competitive landscape is a big part of that. So this is, you know, it's a complicated market.
And maybe I'm wrong, but do you have less and less ancillary coins out there over time? Does some of them just drop off, and then you don't have the trading volumes in those ancillary type coins?
You'd
right?
think so.
I mean,
Yeah, that
I
is
would
completely
think,
true. I would say that's an understatement. So
yeah, I mean, I'm trying to put it like politely, sort of. I don't know why, but yeah.
Yeah, no, I wouldn't.
Like there's a bunch of crap coins, or what we can
There's
call
a
them,
lot.
whatever. They're going to drop off, right? They're
Hundreds
gonna be
of
gone.
them. Hundreds.
Yeah.
Technical
So there
term
was
is
a lot.
Bitcoin.
Yes, there was a bunch of trading volume, literally, and it was literally called that. So
Yes,
yeah,
that is
some,
the
yeah,
actual term that is used.
yeah,
So,
we're not making that up. Yeah.
No.
So
Yeah,
anyways, but
No.
those will all drop off, you'd think. So the
Mhm.
volume that was gained in those, and the fees that were gained out of every transaction from those coins, should drop off. I mean, I guess you could say the bull case would be there'd be more in the bigger coins over time. Yeah, we'll that remains to be seen. I think that's going to end it off for this week. We'll thank everybody for their comments. Any shout outs you wanted to do, Brennan, or anything on the comments there? Just keep commenting on Brennan's outfits.
Yep, thanks, Tyler.
Hear that.
Just
No, and
keep
if you've
commenting. We love the engagement, so we're gonna
Yeah, if
try
you've got
and
any
respond.
questions, put them in the comments. We'll answer them there as
Mhm.
well, or just email them into us, the traditional or old email, or you can tweet us, or you can hit us anywhere on social media, and we'll answer the questions that way as well. I'd like to thank my co-host for hosting with you, and wish you all profitable investing. Thank you.
Thank you all.
Thanks, everyone.
Thank you.